guys, simultaneous wicks. So this kind of wicks is the wicks that you usually see in your forex market. So a series of wicks is the heads up to the change in market direction. So when you see such thing in any market chart, in any forex chart, be it indices, be it stock, be it currency pairs, it indicates a market change in direction. So as the price keep trying to push in a direction, be it either upward or downward, it is being continually met with resistance or support. So eventually this resistance will take over and push the market in the opposite direction. So in the market that was moving upward, like a market that is bullish, upper wicks will show pressure to the downside, right? So and in the downside market, several lower wicks will hint to the potential move upward. So let's take a look at this now. When the market is bullish going upward, the bear are putting pressure on the bullish market. Thereby, when the market tends to buy, it pulls down. When the market tends to buy, it pulls back. It can either be bullish candle, it can either be bearish candle. So we expect to see like 3 to 4 or 5 candle rejections being upward, and those areas will be called, this kind of wicks appears in the area we call resistance, and also appears in the area we call support. So we have some rejection. Some people call it rejection pattern. Rejection candle rejects the area. So the pressure of the like here now, the pressure of the sellers are high, and here the pressure of the buyers are high. So we have a bullish movement where market tends to go up, it's moving up, and we have a rejection of this candle, and the bear now took over the market, and the market goes down, right? So these kind of things gives a momentum that the momentum of the market upward is weak, and it's like there is likely a potential move that the bear market is going to take over the market in order to drop the market downwards, right? Now the same thing applicable to this one. The market is coming downward, and we have a heavy rejection below, which means the bulls are triggering to lower the momentum of the market moving downwards, right? So when we have that rejection candle, see most things on the support area. We call those places support areas, right? Some people call it some supply and demand areas, something like that. Then we have these rejection candles, rejection wicks. We can have it like 3, 4, 5. When you see such thing, then you have a tendency that the market is going to go bullish, and you wait for a signal for a breakout before the market, you can pick up the trade. Or if you are good in analyzing the market, you can be able to enter the trade when you see such thing in the market. So this is high tendency of change in market direction, either upward or downward. So this is wicks I'm talking about. Let's take a look at this on an actual chart. All right, now this is simultaneous wick on a real chart on Euro 15 minutes time frame. Okay, now take a look at this. There's a momentum of downward trend coming down. Market is coming down, and we have the last candle here. We have a rejection, rejection here, which means the bulls are trying to take in charge of the market. Now, you see these long wicks you see here are far more bigger than these ones you see here. So you have the markets went down again, the bulls came in again, the bears came in again, the bulls came in. So we have like 1, 2, 3, 4, 5 wicks. Now what happened after the whole struggle and the whole everything? The market tends to go. So we have this candle that breaks out all this area. Then we can be able to enter a trade. But if you can be able to analyze this and get this kind of rejection on a higher time frame, maybe 4 hours or 1 hour, you can be able to do push into a trade. So this is a rejection spike, series of long wicks being rejected on a support zone. So many people call this support zone, many people call this resistance zone. So when you see this, you call it a resistance zone, and we'll call this a support zone, right? Now, because we have this rejection, market tends to push upward, right? Now, above this area now, this is sell rejection wicks, right? Now, we have the bullish market comes up, the bear people enter the market trying to push it down. Bullish people are struggling to go, it didn't work. The bearish people are pushing it down, bull are pushing it down. Then finally what happened? The bearish people killed the momentum and took the market downwards, right? So when you see such thing like this here, then your next target should be next order block here. This is the last bullish candle on a resistance area. You can draw your line here. Then we have a void here. We have something like void here. You can see that in an actual chart though. When you take a look, we have a void here. We call it smart trader or ICT. You have a void here, so you can also take a look at that. And when you see such thing, enter the trade and can place your first TP and second TP. Even if you have another highs before, previous high before, you can measure that void or liquidity void or breaker block or other blocks. Sorry guys, and push your take TP. So this is that about simultaneous wicks on a rejection area being support and resistance. So when you see this, you can be able to push in and enter a trade. You can see this in volatility indices VIX. You can also see it in Forex charts in the lower time frame 15 minutes. We can also, this can be a two single spike, a one single spike on a high time frame in 4 hours. You see that spike on a 4 hours. We can also see that on 1 hour or daily, depending on this pair, right? So that is that about simultaneous wicks on a real chart. Thank you. Bye for now. See you guys the next lecture.